Hello and welcome to module number 3, where we are going to explore the key principles of the fair value measurement. I'm sure that you asked yourself during the course, how can we measure the fair value for an asset or a liability? IFRS number 13 comes here to the play to answer your question. Fair value measurement are being classified into a hierarchy based on the level of inputs used in the valuation process. This hierarchy defined in IFRS number 13 and consists of 3 levels: level 1, level 2, and level 3. Level number 1 are all about inputs that are quoted prices, which mean that this is quoted price and doesn't require any adjustment. That's why it's called unadjusted also. And these quoted prices are listed in an active market for the same asset or liability that we need to measure the fair value for. And these quoted prices are being measured at the measurement date. This is very important. And we highlighted this fact before, that the fair value are being measured at the measurement date. So these are the most reliable and transparent inputs. Why? Because it depends on the quoted prices in the market. And there is an active market for the same assets, and you don't need to do any adjustment. That's why it's called unadjusted. So this is the most accurate level to project and estimate the fair value based on. So for example, if a company owns shares of a widely traded stock, the quoted market price of those shares would be level number 1 input. Why? Because this share is being traded in the stock market, and this is an active market for the same asset that we need to value. That's why it is considered the level number 1 input and the most accurate source to estimate the fair value from. If the inputs that are related to level number 1 is not available, so we need to move to level number 2. So what are the inputs related to level number 2? These are the inputs that are other than the quoted prices included within the level number 1 that are observable for the asset or liability, either directly or indirectly. This input may include interest rate, yield curve, quoted prices for similar instruments in active markets. So you are depending on something from the market also, but you are going to depend on it in order to estimate the fair value of your asset or liability. So for example, you depend on the interest rate in the market in order to calculate the fair value of your financial instruments, because your financial instrument is not traded in the active market. If it is traded in the active market, so in this case, it will be level number 1, but it's not traded in the market. That's why if it's not traded in the market, you are going to calculate the fair value based on something also from the market, which is observable, which is interest rate in this case, or yield curve in this case. And even if you have quoted price for similar assets, even with some minor adjustments, you are going to consider this as level number 2. Why? Because still you have observable inputs, but for other similar assets and liabilities, which means that you are going to do some adjustments for your assets or your liability. So for example, again, the valuation of a bond using observable market interest rate would be classified as level number 2. And if you don't have inputs related to level number 2 that you can depend on to estimate the fair value, so you need to move to the last level, which is level number 3. In level number 3, there are unobservable inputs that are used when observable inputs are not available, and significant judgment is required. This level involve the use of internal models and proprietary valuation techniques in order to estimate the fair value. So you don't have any observable inputs, but you are going to estimate the fair value using some valuation models. So for example, the fair value of a startup company's technology patent, which may not have readily available market price, could be determined using level number 3 inputs. Why? Because we don't have observable market data. So we are going to estimate it based on some valuation techniques such as income approach or market approach, as we are going to explain later. So the fair value hierarchy is structured to prioritize the use of the observable inputs over the unobservable ones, providing a framework for evaluating the reliability of the fair value measurement. So you have to start from the highest priority, which is level number one, going through the hierarchy down from level number one to level number two, and from level number two to level number three. So level number three, because it depends on unobservable input, so it is the lowest priority. So for example, if an entity has the option to use level number one input, which is observable market prices, rather than level number three, which is internal models of valuation and estimation, so it generally enhances the reliability of the fair value measurement because they are using level number one, not level number three. Now, you might inquire about the word observable and unobservable. So observable inputs are based on the market data that is readily available and can be verified, while unobservable inputs involve assumptions that are not corroborated by market data. So observable data or observable inputs can be seen in the market, in an active market, as a quoted prices, for example. But unobservable data or unobservable inputs are being estimated using some internal models for valuation, such as discounted cash flow method, for example, in order to estimate the fair value based on the present value of the future cash flow. So as you see, this unobservable input depend on internal models for valuation. That's why it's considered the lowest priority when it comes to measure the fair value. Another example, if a company value its inventory using recent market prices for similar items, so in this case, they are using observable input because they are depending on recent market prices. So it's considered more reliable than estimating the inventory's fair value based on the company's internal projections, which is in this case considered as unobservable inputs. Understanding this hierarchy and the distinction between observable and unobservable inputs is crucial for applying the fair value measurement consistently and transparently. It ensures that the financial statement users can assess the reliability of the reported fair value. If you have any further questions or need additional examples, please feel free to ask, and we will respond to all of your questions at the soonest. In the next module, we are going to explore the evaluation techniques which are related to level number three specifically. Stay tuned and see you in the next module.